The consensus on Wall Street is crumbling, and most people haven't even realized the ground is shifting beneath their feet. Think back to the beginning of this year. There was one trade that was considered the most crowded on the street. Every analyst and their mother swore by it. The US economy is going to crash, treasuries are the ultimate safe haven, and the US dollar has to fall. It sounded reasonable. It followed every rule in the Economics 101 textbook. Well, 6 months have passed, and the market has slapped everyone in the face. Why did the textbooks fail? Because we are witnessing a fundamental fracture in the logic of global capital costs. This isn't just about rate fluctuations. This is a massive asymmetrical great divergence between the Federal Reserve and the European Central Bank. This divergence decides the fate of the euro against the dollar, and it decides the true valuation of those growth stocks in your portfolio. If you don't understand this game of chess and you're still trading based on the old playbook, congratulations. You are likely becoming the bag holder of this cycle. Let's look at what the data is actually screaming at us. To understand why the market is so anxious, we have to talk about the concept that keeps macro traders up at night, R-star, or the long-run neutral interest rate. For the past 6 months, a silent debate has raged on Wall Street. Even though the Fed has started recalibrating rates down from their peak currently sitting in the 4.5% to 4.75% range, the real panic is this. What if they can't go much lower? The original script was, inflation cools and rates return to our comfort zone of 2% or 2.5%. But the US economy is acting like a beast that refuses to be tamed. Whether you look at the revisions in non-farm payrolls or the slight tick up in unemployment, you cannot hide the core fact. The US economy is alive and kicking, even at these rate levels. What does this mean? It means R-star, the theoretical rate that neither stimulates nor restricts the economy, is actually much higher than the Fed admits. It's likely not 2.5%, it could be 3.5%, or even 4%. This is the true meaning of high for longer too. It's not that the Fed doesn't want to cut rates, it's that the structural reality of the economy suggests they can't cut aggressively. Why? Look at capital expenditures. Capital expenditure. The US is in the middle of a capital expenditure supercycle driven by artificial intelligence and reindustrialization. The massive infrastructure build-out by tech giants for AI and the factory onshoring driven by the CHIPS Act, these create massive demand for credit. When everyone is fighting for capital to expand, the price of capital interest rates naturally gets pushed up. It's supply and demand. In a drought, water isn't cheap. Now, look across the Atlantic. Europe is living in a parallel universe. While the US economy flip-flops between overheating and soft landing, Europe is stuck in the mud of an implicit recession. German industrial output is quite frankly a disaster. Structural increases in energy costs have permanently crippled the competitiveness of European manufacturing. The ECB doesn't have the luxury of worrying about whether rate cuts will reignite inflation. They are facing an existential crisis. If we don't cut, the economy suffocates. This is the core of the divergence. The Fed's current cuts are a recalibration, a preventative fine-tuning to stop real rates from getting too restrictive. The ECB's cuts are emergency triage. This fundamental decoupling is causing a violent repricing in the bond market. Look at the US 10-year Treasury yield. Despite the Fed cutting, the yield stubbornly bounced back to 4.2% and above. The market is voting with its feet. The bond vigilantes don't believe US inflation will easily return to 2%, and they don't believe long-term rates are going back below 3%. This isn't just a numbers game. We are on the eve of massive second-order effects. When the 10-year Treasury, the anchor for global asset pricing, is pinned above 4%, every valuation model for risk assets needs to be rewritten. Those growth stocks you bought in 2021 that sold you a dream with zero free cash flow, their valuations were built on the assumption of zero interest rates. Now, the denominator has changed. If the numerator, their actual earnings power, can't keep up, a valuation reset is inevitable. The deeper impact is in currencies. The EUR-USD pair is being torn apart by these forces. Interest rate differentials are the gravity of the forex market. When the US keeps rates high due to strength, and Europe is forced to cut fast due to weakness, capital flows naturally to the higher-yielding dollar. This isn't just hot money. This is a massive asset allocation shift by pension funds and sovereign wealth funds' real money moving into the US. we are likely seeing the dollar exhibit a counterintuitive resilience. Traditional theory says, Fed cuts, dollar falls. But in a global game of who is the least ugly, if your opponent is cutting harder because their economy is broken, the dollar becomes the safe haven. This is the right side of the famous dollar smile theory, a strong dollar supported by US exceptionalism. If we don't look at history, we fall into emotional traps. We've seen this divergence before. Back in 2014 to 2015, the US ended QE and talked about hiking, while Europe started printing money. The result? The euro collapsed from 1.4 to 1.05. The lesson? Don't underestimate the inertia of capital flows. Once the trend starts, it lasts longer than you think. But there is a key difference today: fiscal dominance. In 2014, the US government was trying to control the deficit. Today, we are in a peacetime war economy fiscal mode. The US deficit is over 6% of GDP. This massive fiscal stimulus creates economic resilience, but it makes inflation sticky. Europe, bound by the fiscal handcuffs of the Maastricht Treaty, is far less aggressive. This puts Fed Chair Powell in a situation similar to Alan Greenspan in the 90 seconds productivity gains, then the internet, now AI, plus strong demand keep rates high. But here is the risk: the ghost of stagflation. If US resilience is built on unsustainable debt, inflation could bounce back. If CPI ticks up and the Fed pauses, cuts, or, God forbid, discusses hikes, asset prices will face a liquidation event. The market is dancing on the rim of a volcano. So, the diagnosis is clear. How do we allocate capital in a world of high for longer too and European stagnation? This is no longer the era of buy the SPY and go to sleep. In a rate-divergent world, beta market return flattens out. You need alpha. 1. The currency strategy. Embrace the carry. This isn't just about shorting the euro. It's a carry trade logic. Holding short-duration USD cash equivalents like T-bills still offers you a risk-free return around 4.5%. Holding euros is burning your purchasing power through inflation and currency depreciation. If you hold European equities, hedge the currency risk. If the euro breaks 1.05, the door to parity swings wide open. 2. Equities. Be picky with US exceptionalism. Do not buy European stocks just because they look cheap. That is a value trap. Without massive stimulus from China, which looks unlikely, European cyclicals are dead money. Capital will continue to crowd into the cash cows of the US market. In a 4.5% rate environment, only companies with a return on invested capital, ROIC, significantly higher than the cost of capital can survive. This means big tech remains the bunker not just because of the AI story, but because they have massive free cash flow. They don't need to borrow to grow. Warning: stay away from the zombie companies in the Russell 2000. Many small caps are surviving on cheap debt that is about to expire. The maturity wall is approaching, and high rates act like a scalpel cutting out the dead tissue. Don't catch falling knives. 3. Fixed income. The barbell strategy. The term premium on long-term bonds is returning. Don't bet the farm that yields will drop back to 3.5% quickly. Use a barbell strategy. One end is ultra-short T-bills to lock in the high coupon. The other end is high-grade corporate bonds. Avoid long-duration bets where inflation volatility can wipe out your capital gains. Opportunity. If you have access, look at private credit. With banks retreating, private credit is filling the void. If you pick the right managers, double-digit yields are available here. 4. The tail risk hedge. The US-EU rift could spill over into trade. If the US gets aggressive with tariffs, the dollar strengthens further. Include macro hedges in your portfolio, a small allocation to gold as a hedge against fiat disorder, or defense stocks, which is the one area where Europe must increase spending. We are not experiencing a simple business cycle fluctuation. This is a paradigm shift in the macro narrative. For the last 15 years, investors were spoiled by central banks, playing the role of the nanny, fixing everything with infinite liquidity. But now, sticky inflation and economic divergence have tied their hands. The Fed and the ECB are no longer dancing to the same tune. In this new world, passive investing becomes inefficient. It's not that index funds are dead, but if you don't adjust for currency and duration in this macro environment, your real returns will be quietly eaten away. Don't wait for a bell to ring telling you the bear market is over. This market is now capital-intensive trench warfare. The winners will be those who can identify where real return on capital exists, not those fantasizing about a return to the zero-rate party of 2021. Focus on ROI. Focus on real cash flow. Focus on assets that can thrive in a 5% world. I'm your name, and this is Deep Dive Financial Analysis, not financial entertainment. If this logic helps refine your investment framework, hit subscribe. Next time, we'll talk about why what most people think is hedging is actually just adding more risk.